nothing goes straight down. It's not a smooth ride. It's not an elevator down where you just, the data just goes down and down and down and down. Then it gets to a certain point, and then it goes up and up and up, right? It's going to bounce on the way down. And so that doesn't really explain, and the market knows this, so that doesn't really explain the issue for the rise in rates. Yesterday, as I was talking about, yields pushed higher, and that weight on stocks. And again, this has been this kind of issue as of late. Stocks and bonds both correlated, so bonds go down, stocks go down at the same time. And of course, now the media is trying to figure out all the reasons. Okay, well, why are yields going up? Well, it was the JOLT survey. It really doesn't explain that, because again, the trend for JOLTs is lower. And the economic data is certainly weakening. Employment growth is weakening, et cetera. So yeah, but as we talked about yesterday, hey, you're going to have these little upticks in data, right? Nothing goes straight down. It's not a smooth ride. It's not an elevator down where you just, the data just goes down and down and down and down. Then it gets to a certain point, and then it goes up and up and up, right? It's going to bounce on the way down. And so that doesn't really explain, and the market knows this, so that doesn't really explain the issue for the rise in rates. What I think is going on here, and if we take a look at liquidation, we've had $50 billion worth of liquidation in a week in equities. And that is one of the largest liquidation events on record. So now, could just be, CTAs, these computerized trading algorithms, et cetera, just selling assets because we're triggering certain support levels. That certainly could be the case. And when that's over, that'll be over. And then they'll start buying again. And that group of traders, which is very large, they command hundreds and hundreds of billions of dollars at their disposal. So their movements in and out of markets can certainly affect and has certainly exacerbated these moves we've had in prices, both up and down, right? We can attribute them to the rally we had earlier this year. We can now attribute them to this decline. So they have certainly contributed to the volatility of the market, but the magnitude of the selling over the last 2 weeks in particular, when we talk about the actual dollar volume transacted, has been rather large. And then again, just recently, very sudden over the last week, we've had a tremendous amount of liquidation, which is more in line with what we've seen at previous events where the media is trying to assign some reason to it. And we don't know what the real reason is, but we find out 3, 4, 5 months later that it was a hedge fund, pension fund, something in trouble, and they were having margin calls, et cetera. And I suspect that over the course of the next couple of months, and again, if we go back to a good example of this is go back to 2019. So in 2019, remember in 2018, right, we had the Fed taper tantrum, the Fed's hiking rates, market declines by like 20%. President Trump at the time is all over Jerome Powell for hiking rates and, damaging the economy, and it's all his fault. And things were kind of getting a bit stressful as we got into the beginning of 2019. By June, the Fed is cutting rates back to zero. Now, nothing's going on, right? There's some economic ripples, but no real fear of a recession. Nobody was concerned about a recession. Nobody's talking about a recession. All of a sudden, kind of out of the blue, the Fed's cutting rates back to zero. Everybody's like, well, Jerome Powell acquiesced to Donald Trump. Donald Trump got to Jerome. Jerome's cutting rates to keep his job. Go back and look at the articles. Tons of article headlines about this during that period. Then, in September of 2019, I was writing an article about the National Federation of Independent Business because there were alarm bells going across the board from the National Federation of Independent Business. Their kind of recession signals were all ticking off. Now, that didn't align at the time with the economy. The economy was doing just fine. But yet rates were back to zero. And so now we have these alarm bells going off about a recession. And then we find out in September that the Fed is doing this massive amount of reverse repo operations and just providing tons of liquidity. And there was this problem that was going on about collateral. People were demanding very high rates for guaranteed collateral to make overnight loans. And so something was certainly not right. And the Fed stepped in, started doing this massive repo operation, did like $1 trillion worth of this stuff. And then we find out much later in the year, as we were kind of getting into December, January, February, that the Fed was actually in the process of basically bailing out Citadel Capital because of margin calls and things that were going on. So a lot of the action that's currently occurring, now the Fed hasn't stepped in yet that we know of, right? And we'll find out because we'll get data on reverse repos. We'll get data on, these bank term funding programs, et cetera. We'll get that data coming out soon. And we'll be able to see what's going on and take a look at the balance sheet. Is the balance sheet reduction still continuing as normal, or did it stop? But we'll find out over the course of the next few weeks, kind of what's going on and kind of what was driving this particular spat in the market. It could just be a simple sell program that just went kind of AWOL. And that's happened before too. So maybe it's a nothing event, or maybe it is something that's going on kind of behind the scenes because of higher interest rates, because of what's happening within markets, the economy, et cetera. That has been the overriding risk, that eventually something breaks within the financial system. And the question is has it broken yet, or is it just beginning to break? That's the question. So, we have this issue of higher yields, which is weighing on a variety of assets across the board. But then we also have this market that's very bifurcated. We've had 7 stocks basically driving the markets, the rest of the stocks kind of struggling along here. So again, this could just be a normal, typical kind of end of the summer type sell-off, repositioning for the end of the year. Could be that, might be nothing, could be something. So it's something we certainly must pay attention to. We don't want to panic about it and start making drastic moves at the moment because markets are extremely oversold. And again, this was kind of interesting yesterday. Despite the rise in yields yesterday, utilities, which are very interest rate sensitive, did great. They were up strongly yesterday. We had added to our position in Duke Energy early in the morning, and utilities turned around mid-afternoon and started having a very nice rise into the evening because they've been under a tremendous amount of pressure. They too are very oversold here. So again, you got to be a little careful here. But if something is going on, we're going to start to see data that supports that something in the financial markets is under strain. If that is the case, then you can expect, you can well bet that the Fed is done hiking rates. And depending on what happens next, now if the markets turn around here and just start rallying through the rest of October, the Fed meets at the end of October, 1st of November. So at their next meeting, if everything is fine in the markets, they're going to just kind of be status quo. Yep, economy's doing okay, we're fine, we don't need to do anything. We're going to, we could raise rates one more time. They're going to keep that one rate hike that they've got left in their pocket. They're going to leave that hanging out there. They're not going to pull that off the table until they have to. So if we get to the end of this month and things are still under a lot of pressure, there's going to be a rising probability the Fed says, okay, we're done. If there is something breaking, you can guarantee that they're going to basically allude to the fact that they're done hiking rates. They'll say something like, rates are sufficiently restrictive at this point. They'll make some comment that makes no sense, but they'll make some comment that basically will allude to the markets that they're done hiking rates, and that will be because they realize that something is broken or is about to break in the financial markets. And when I say the financial markets, it could be banks, it could be equities, it could be, anything. Again, the bond market's the biggest concern for the Federal Reserve. So, what's happening this week? Is it a one-off? Maybe. We'll keep a watch on it. It's nothing to panic over. Markets are very oversold here. So again, look for bounce to sell into, raise some cash, rebalance your equity risk accordingly. But don't panic sell here. We could be under a bit more pressure here for the rest of this week. But again, we're so oversold, you're going to get a technical bounce. Then from that point, you can make a better decision about what to do with your money. Be right back after the break. Wrap up the show.
The Real Investment Show.
So just getting ready to wrap up the show this morning. Yields down a bit this morning. So a little bit of a relief after the spike yesterday. And again, yields kind of all over the place right now. And again, kind of knee-jerk reactions to data. One thing we've got going on with bond yields in particular. So the yield, and let's explain a couple of things here. I get a lot of questions about. I'll give you a good example yesterday. So a guy emailed me and he had bought a treasury at a lower coupon a couple of months ago. And he's like, should I sell that bond and then buy this new bond because this new bond is now, at 4.74% or 4.8%, whatever the number was. It's a higher coupon. And I was like, it makes no difference. And he's like, what do you mean it makes no difference? I said, because the yield is the same. And this is a very important concept to understand. The yield and the coupon are different. Those are not the same. The coupon is the stated interest rate on the bond. So let's just simple math just for a minute, okay? So let's just use real simple math. I got a 1-year bond that pays a 5% coupon. So I put $1,000 into it. At the end of the year, on day one, I put $1,000 in. So at the end of the year, I'm going to get my $1,000 back, and I'm going to get a $50 interest payment because it pays 5%. So my return for 1 year is $1,050. Okay. If interest rates go to 6%, so the next year, I have this bond at 5%. Now yields are 6%. The price of my bond will fall in price so that the difference between the current price and where it matures at par, and just follow me for a second, I'll explain the math, is the same as a new bond that pays 6%. So in other words, what has to happen to my bond in order for it to be equal to a new bond with a higher rate? So in this example, so now it's year 2, right? I've got, and again, the reason this happens is why would I want to own a bond that pays 5% if I can buy a new bond at 6, right? So this was the question that I got by email. And the answer is you wouldn't, right? You wouldn't pay $1,000 for a 5% coupon if you could spend $1,000 and get a 6% coupon, right? It makes no math. It makes no math. It makes no sense. The math makes no sense, right? That's what I'm trying to say. So what has to happen with the bond is that the bond price will fall to $990 for the 5% coupon. And so now you buy that bond at $990, and at the end of the year, right, you're going to get $1,000 back because that's the face value of the bond. So you're going to get $1,000 back. So you made $10 in capital gain, plus you get your $50 coupon. So you get $60 in total, or a 6% coupon. That's why yields are always equal. So don't worry about the coupon. Always focus on the yield that you're getting. And so if you have a bond at one price and then a new bond's issued at a higher coupon a few days later, the yield will be the same on both because yields are always the same. The yield on the 10-year treasury at 4.75 or whatever it is today, That's the yield across the board. Price goes up and down. That's only, and the reason the price moves up and down in bonds is because it's adjusting for the yield. It's saying that if you want to sell your bond on any given day in this current yield environment, that's the value of the bond, because whoever buys that from you wants the current listed coupon out there. So the current listed coupon is 6. You've got a 5% coupon bond. I'll buy your bond, but I'm going to buy it $990, not $1,000. So you're going to lose $10 on your bond so that I get the same yield as I would get buying a brand new bond at 6%. So I know that's confusing. Bond math is confusing. It's like my wife's girl math. She's convinced that if she buys something at 50% off, she made $50. So I'm just joking. That's not even close to true. She's very frugal with money, but I always tease her about girl math. She's now coming up with things about guy math.
Oh.
Yeah. So every time I buy a new gadget at the house, she's like, guy math. I'm like, hey, yeah, but I save money because I don't have to work as hard. My time is worth money, so I'm saving money if I buy something that reduces my workload at home. Guy math. But I know bond math is hard, and this is why we don't spend any time in the media explaining bonds, and so there's a lot of misconceptions about how bonds work. But again, what happens in the short term over the course of a month or two, and yields can do anything in the short term. Right now, we've got a lot of liquidation. There is a record level of shorts against Treasury bonds right now. So you've got one side of this speculative market that is just shorting bonds. So the more the yields fall, they just keep shorting them, right? And so as they short them more and more and more and more, it's driving the price down because they're providing that selling pressure on bonds, despite the fact you've got record inflows of capital going into Treasuries. You've got a bigger side shorting them at the same time. So, this is that offsetting conundrum. Now, the issue is that when that turns, for whatever reason, you have a recession, economic slowdown, the Fed just says, hey, we're done hiking rates, whatever it is, whatever causes yields to turn, the reversion of that short position is going to drive yields down very quickly. So again, it's just a function of time before that happens. But we get into these cycles where, again, just like the stock market, stocks can only go up there. It's like in 2020, they're going up here forever. And then in 2022, you have a bear market, right? Beginning of this year, stocks are up 15%. Oh, stocks can only go up from here. And then you have a 7% correction. Everybody's like, oh, stocks can only go down from here. So again, it's always about psychology. It's we get trapped into this idea that, things are only going to go in one direction forever. They don't go in one direction forever. You've had a massive decline in both bond prices and a massive rise in yields. That's unsustainable long term. You're going to break something in the economy or financially, and maybe we've already done that. But when that recognition of that event occurs, that's when yields fall. So again, it's just a biding of time until you get to that point. It's always interesting, and just I want you to think about one thing real quick for me. To set aside what's happening right now. In the last 20 years, if you could go back in time, if you could get into the hot tub time machine and go back in time and select a date, just select a day that you could just put all your capital to work. You can, and just for the fun of this exercise, everybody's got $1 million to invest. If you could go back in time and pick a point in the last 20 years where you put your money to work, what day would that be? For me, it'd be March the 9th, 2009. See, hindsight's a perfect science, right? We can go back in time and say March 9th, 2009, then we had a 400% advance in the market. See, that's easy. But at the time, now, I say go back in time to March 9th, 2009, put your $1 million to work, but without the foresight of knowing what's going to happen next. See, and back then, everybody was convinced the market was going to zero. Nobody was willing to put capital to work, and you certainly wouldn't put 100% of your capital to work in the S&P on March the 9th, 2009. Because everybody was convinced the market could only go lower. We were in the middle of a financial crisis. Nobody knew about QE and all this other stuff that was going to come. So here you are today, faced with a 50% decline in bond prices, very much akin to any other major bear market in history. You've never had 3 years of negative returns in bonds in history. You may have one this year. But in 10 years, if you can look back and pick the point to where you could put your $1 million to work, where would it be? See, this is the problem with emotions and investing and why it's so hard. Because when you get into these periods of uncertainty, we don't like uncertainty as humans. As humans, we abhor uncertainty. We abhor pain. And this is why, as Baron the Rothschild once said, he says, you have to buy when there's blood in the street. There's blood all over the bond market right now. Nobody wants it. Not saying you go put all your money into it, but you have to think about what happens next. And there's a big difference between bonds and stocks. Stocks can go to zero. Stocks can. The U.S. government bond cannot. And if it does, nothing else is going to matter anyway. But we're going to pay, the bond's always going to get paid. So there is a limit to the price of how far bond prices can fall. Tough right now. No, it's a tough environment. Period. Been a tough year. But we have to start thinking about what happens next. Anyway, have a great day. Get by the website. Our latest articles are out. Michael Leibowitz's new article is out on the website right now as well. Just posted out this morning. So that's on the website, realinvestmentadvice.com. While you're there, send your questions, comments, emails. Let us know what we can do for you. Have a great day. We'll see you back here tomorrow, and we'll talk probably more about stuff right here on the Real Investment Show. Kind of like Seinfeld, the show about nothing. We're going to change our tagline. It's a show about stuff. We're going to talk stuff. All right. See you tomorrow. Have a great day.